Is Dow Chemical a potential buy now? We're analyzing Dow, stock ticker DOW, using the Select 6 analysis. We're looking at the most telling financial metrics before estimating a fair value for this stock. You're going to want to watch till the end when we give a rating to the business. This analysis is intense but worth it. Along the way, there's going to be a key bonus metric that just might be the difference when looking at Dow for your stock portfolio. Before we get into these valuable metrics, how has Dow's stock performed? Right now, Dow trades for $52.46 per share. Year to date, their stock price is up 3%. While this is up, this underperforms the S&P, which is up 16%. Right now, Dow pays a big 5.29% dividend yield. Their average dividend yield is added to any returns in their stock. Since the merger and separation of Dow-DuPont, Dow as a standalone business is down 6% overall. Keep in mind these aren't their total returns. Their average dividend yield throughout this time is added to these returns. Dow trades $8 below its 52-week high. The company is also $8 above its 52-week low. 1.5% of their shares are sold short. Dow's a big business. They have a $37 billion market cap. But the burning question is, why should we be paying close attention to Dow? Dow Chemical is a diversified global chemicals producer that was formed in 2019 as the result of the Dow-DuPont merger and subsequent separations. The firm is a leading producer of several chemicals, including polyethylene, ethylene oxide, and silicone rubber. Its products have numerous applications in both consumer and industrial end markets. Now let's dive deep into their numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Dow's been a standalone business since 2019. Their numbers we'll see throughout this analysis in 2018 are going to be as a combined company. In this time, Dow has increased their returns on capital. These have been boosted since 2020. In the last 5 years, when their returns on capital are averaged out, Dow earns 13.7% returns in a given year. That's very, very close to the 14% we were looking for, even though it's solidly above average. This is an X on our first metric. Metric number 2, we're looking for growth. We want to see 5-year revenue, net income, and free cash flow growth. All three need to be up for this to be a check. We'll also include their numbers up until today, which aren't shown on this chart. Dow took a big hit to their revenues in 2020. Since then, these are up quite a bit. As a standalone business, since 2019, Dow has grown their revenues. Today, they have just as much revenue as they did as a combined company in 2018. Their revenues are up. The company's net incomes, however, are down 62%. They were negative in 2019, they're positive today. A bright spot for Dow is their free cash flow growth has led the way. Their free cash flows have grown by 66% over this time. Free cash flows are the way a business is valued. We'll use 2 different methods later in our analysis to estimate Dow's fair value, so you'll want to stick around. Because the company's net incomes are down, however, this is an X on metric number 2. Metric number 3, we want to see earnings per share growth. This looks at Dow from the view of an individual shareholder. In this time, we learned their earnings have declined by 62%. As a standalone business, however, Dow has bought back 5% of their shares outstanding. Still, these buybacks aren't going to outpace their earnings decline. This is an X on metric number 3. We're just getting things started on metric number 4, where we're looking for free cash flow per share growth. In this time, their free cash flow growth of 66% and their 5% share buybacks work together. Dow has grown their free cash flows per share even faster than these. This is a check on metric number 4. What will the rest of our analysis look like for Dow? We'll get to that in just a minute, but first we need to cover our bonus. We want Dow's dividends to be supported by their free cash flows. Right now, Dow pays a big 5.29% dividend yield. In these years as a standalone business, Dow has easily supported their dividends using their free cash flows. Overall, they've grown both their dividends and their free cash flows. They maintain a reasonable dividend payout ratio. That's the case in the last 4 years, and today, it's exactly what we're looking for. This is a check on our bonus. In recessions, it's businesses with too much debt that are at the biggest risk of going bankrupt and losing money. Metric number 5, we want Dow's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In this time, Dow has reduced their net debt position. They've also increased their free cash flows. They ended last year with $11.8 billion of net debt. Today, they have $12.6 billion of net debt. In their last 5 years, they produced $20.5 billion of free cash flow. That's more than enough to comfortably support their debt position. This is a check on metric number 5. In their last 12 months, they produced $3.3 billion of free cash flow. When we project that out over the next 5 years, that also supports their current net debt position. Based on their free cash flows, Dow looks like it's in healthy financial shape. Now let's estimate their value. The big metric of them all, metric number 6, we want Dow's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Dow. Right now, Dow has a $50 billion enterprise value. In the last 5 years, we learned they produced $20.5 billion of free cash flow overall. This means in an average year, they produce $4.1 billion of free cash flow. When that's divided by their enterprise value, we get an 8.2% average free cash flow to enterprise value yield. That's coming in above the risk premium we're looking for. On a current basis, Dow produced $3.3 billion of free cash flow in their last 12 months. When that's divided by their $50 billion enterprise value, it gives us a 6.5% current free cash flow to enterprise value yield. That's also above the risk premium. This is a check on metric number 6. Don't just run out and go buy the business. We still need to estimate their fair value per share and give our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Dow. This takes us on to using a discounted cash flow model to estimate their fair value per share. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Dow's current free cash flows, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for Dow. Assuming they grow their free cash flows at 3% annually for the next decade, then in the following decade, assuming this growth slows to just 1% annually, we'll add in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples stay the same 20 years into the future, an estimate of Dow's fair value per share is around $50. That's just a couple dollars below their current stock price, well above their 52-week lows. Keep some key points in mind. Dow doesn't have a long track record as a standalone business. They just separated from DuPont in 2019. This means they have a low business predictability, which can impact our assumptions. This valuation is likely rougher than it would be for some other types of businesses. Also, this discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes both their average dividend yield and any potential gains in their stock price. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our rating, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Dow. Why don't we figure out what these are? Looking at the factors supporting a long thesis, number 1, Dow Chemical benefits from its cost-advantaged North American operations that use low-cost natural gas-based feedstock. Number 2, Dow maintains exposure to a wide variety of industrial and consumer end markets, somewhat mitigating the risk of a potential industry-specific downturn. Number 3, Dow's process technologies may improve the firm's profitability, while at the same time providing an asset-light revenue stream through licensing agreements with other chemicals manufacturers. But it wouldn't be fair if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, the vast majority of Dow's products are commodities whose prices move with Brent oil prices. As Brent oil prices may fall, Dow's realized prices and profits will fall accordingly. Number 2, Dow's North American natural gas feedstock-based cost advantage may erode over time due to a permanent increase in North American natural gas prices. This would lead to margin compression over the long run. Number 3, tightening regulations around hazardous chemicals may force Dow to invest significant resources in developing alternative products that may raise the firm's operational costs over time. There you have it for a balanced perspective of some of their qualitative factors. Now it's time for our rating. Dow Chemical checks the box on 3 out of our 6 metrics. They earn high returns on capital even though they were slightly off from what we were looking for. Their revenues as a standalone company are up, but they're down from what they were at with DuPont. This makes sense. The company's free cash flows are up by quite a bit. They've also been buying back some shares. It looks like Dow uses a reasonable amount of debt in their business. They support their free cash flows however you look at it. They've also supported a growing dividend in the last 5 years. Plus their free cash flow yields may be attractive compared to the 10-year treasury. Keep in mind this isn't financial advice. When we performed our discounted cash flow analysis, if today's valuation multiples are the same in 20 years, you believe those assumptions and you want a 15% rate of return, an estimate for Dow's fair value is around $50, just a couple dollars below their stock price. When you add in the qualitative factors for Dow too, they look like an interesting candidate for more research. If you like the analysis, subscribe to the channel for more.